In this episode, we're talking about the true value of assets. Welcome to episode 22 of Access Granted. It's a great episode today. It's exciting. We've got Craig joining us today to talk about the idea of intrinsic value. So this is something that we talk about pretty regularly when we're looking at investments and when we're determining what they're really worth. So Craig, why don't you guide us through what is intrinsic value?
Sure. So intrinsic value is sort of a technical term. What it basically means is what is the value of all of the future cash flows that an investor is going to receive from that investment that they're making. So that's a technical way of saying it, but realistically what you're talking about is what are you going to earn from the profits of the company that you're buying if it's a stock, or what are you going to earn from the distributions that the bond's going to pay you. Another way of saying it, maybe a simpler way of saying it, is what would a purchaser pay for a business if they were going to buy the whole business as opposed to just one share of it. And that's a good way of describing intrinsic value.
Perfect. So really what it's worth.
Exactly.
Okay, so when we're talking about value, what clients generally see on their statements is the market value of it. So,
Right.
So what's the difference between intrinsic value and the market value?
Well, they can be very different actually. So in most situations, the market value that a company trades at or that a bond trades at is going to be pretty close to its intrinsic value, because markets are pretty efficient for the most part, especially some of the bigger markets like the New York Stock Exchange market or the TSX market are pretty liquid markets, so they're pretty efficient. But even they, in times where there's extreme fear or there's extreme greed in the market, these market values can sort of disconnect from the intrinsic value of a company. So when that happens, there can be opportunities for investors to identify that and make a trade which they can profit from based on that mispricing in the market.
So it's safe to say then the intrinsic value is going to be far less, or should be far less volatile than the market value, which will be fluctuating with the case of stocks daily, if not minute by minute, right? So
yeah, absolutely. The intrinsic value with a good company tends to grow over time, but the market value can be very volatile in between. Even though that intrinsic value steadily grows, depending on what the sentiment in the market is, market values could be up or down.
okay, that's great. So that gives us a really clear example or answer about what the difference is between what clients regularly see market value and what the value of the businesses or the assets that we're looking to buy and invest into. Can you give us like a real life example of something that we've seen recently?
Yeah, there's actually a good example, which is still playing out actually a little bit, but in some of our clients' portfolios, they own a company called HSBC, and this is a really good example of a case where the intrinsic value disconnected from the market value. So everybody knows about Brexit. There was a referendum, and leading up to the referendum and in the immediate aftermath, a lot of the UK-based banks, like HSBC being one of them, were really hit hard in the stock market because there was a lot of fear coming out of the market based on the fact that London is a big financial center and nobody really knows what Brexit means for London as a financial center. So banks especially people were fearful that they were going to lose a lot of money on their bank stocks. So the price of HSBC went from about $52 in 2014 down to about $30 by the time of the referendum in 2016. We looked at that, and there was some really panicky selling in the market around that time of the referendum, and so we looked at that, and we basically said, okay, well, HSBC's profits, 75% of them come from Asia, actually. So does Brexit really affect them this much? Probably not. So we started buying it, and the price is trading up at $55 now. So if you had bought in July of 2016, which we did, you've done really well.
So a great opportunity where the intrinsic value we felt was up here, where market value was trading down here.
Yep.
Great place for us to buy and hopefully realize our intrinsic value at some point.
Yeah, and I would argue you made a really nice return, and I think you made that return with very little risk because you know, even if things hadn't gone as well for HSBC, I think we still would have preserved capital by buying at that low price. So.
Awesome. Great. So that gives you a little bit of an insight as to what we're looking at when we're looking to choose our investments. You know, with the difference between market value, intrinsic value, and you know, gives you a little bit of insight into what's going on with us. So, thanks very much for checking this episode out. If you have any other questions, feel free to send them to cgwfamilywealth@nbc.ca, and be sure to go to our website, cgwfamilywealth.com. With that, we'll close it off. Ready? Aim. Fire.